So our portfolio, Asia Pacific Real Income, is all about trying to look at three key themes that we think deliver sustainable dividends. And that's the most important point, sustainable dividends. So we're trying to achieve high attractive income, but growing income, as well as a nice total return overall. So we want capital growth. So you want all three concepts. And so there's ways of looking for income, which is by investing in what we think three key themes. One is real estate investment trusts. They provide a healthy income and investing in real assets. Secondly, investing in utilities, which we feel that if they are network utilities, i.e. they own the grid lines, the power distribution, the transmission mechanism, these are really interesting long-term strategic assets, and they often have monopsony power, i.e. they can control pricing and they can control supply to a certain extent. And thirdly, we like kind of more pure infrastructure investments in the sense of companies like toll roads, airports, seaports. These companies, again, are in strategic positions to grow long term as the population in the world grows, as urbanization comes into play. And in those kind of companies, you have strategic assets which, again, to a certain extent, has pricing power. If you have pricing power, you can predict your cash flows to a certain extent. Quality, valuation, direction, and sustainable dividend. Now, quality is something that we can all kind of get our arms around. What is the quality of a company's management, quality of their business model, quality of their assets? And again, remember, we're talking about real assets. Then it's in the name of the fund, real assets. Things that are physical to a certain extent, provide essential services to the population. And so when you're looking for quality, you want to make sure that the business is well run, it's well managed, the shareholders are well appreciated by corporate, because at the end of the day, we as shareholders want to be paid so that our clients can actually get a reward function for the investments that they make. So that's really quality, right? Bringing in that kind of broad quality perspective. And then valuation and direction are really about earnings. If you think about valuation, we want to buy companies which are intrinsically cheap over the long term so that we can make money from them. And so what we look for is companies which are earning well, have normalized earnings, and look at what the kind of pricing those earnings are relative to the market. Is the market underpricing the quality of those earnings relative to the quality of the business it is? Direction is slightly different. Direction is saying, okay, this company can earn really good money, but actually, if you look at it today, which way is it heading? Is it heading up or is it heading down in terms of its earnings? And does that kind of give us an indicator at which point we should be potentially buying into that stock? So again, direction is a useful analysis, a perspective to have, so that you can understand, maybe help your timing of that investment opportunity. Fourth is sustainable, kind of sustainable dividends. And this is really important. We want to provide an attractive income in our portfolio, but to do so, we want it to also be a growing income. So sustainable dividends is all about looking at companies' cash flow, making sure it's resilient, that they have enough money to pay capex, to pay for interest rate debt, and to give shareholders a healthy dividend over time and a growing dividend. Some companies can promise very nice high dividends, and you find that they can do it for 1 or 2 years, and then 3-4 years down the line, they have no ability to pay that. So by doing really good fundamental research, investigating those companies, understanding those business models, we can work out if that dividend is likely to be long-term, i.e. sustainable. So there's nothing wrong with standalone REITs or standalone investment properties or standalone infrastructure, but what's the benefit of blending the three things together? And I think the benefit is you move away from things like concentration risk. When you only invest in one category, pure infrastructure, pure utilities, pure REITs, you take, in many ways, that sector risk. You can't get away from it. You can moderate it maybe, but you can't really get away from it. So if REIT valuations are very expensive, cap rates are low, valuations are very expensive, what do? It's very hard to try to allocate money. However, there are periods in each of these three different themes where valuations look attractive. So in many ways, from a bottom-up perspective, by being able to invest in all three categories, we can pick and choose where we feel there are opportunities and value based on the underlying fundamentals. We're not making top-down calls. We're not saying we believe X is better than Y is better than Z. What we're saying is from an underlying stock opportunity basis, we see opportunities in certain sectors more than others. So for today, for example, we own 47% in REITs, 33% in utilities, and 20% in infrastructure, pure infrastructure. That's today, right? In a year's time, the numbers might be slightly different, but that's based on bottom-up opportunities. And so we are looking for ways of making sure that the portfolio is diversified. First of all, we don't have concentration risk, so we're only invested in one category. You often face the risks of that one category. You know, people are saying, talking to me currently about why invest now. Well, the stock markets around the world have come down, especially in Asia. And actually you're buying these companies at lower prices. But these companies are generally more defensive anyway, and they're stable, and they've got good cash flow. For example, the average yield of our portfolio for the next 12 months is about 5.3%. And the actual dividends we're expecting to receive, we expect them to grow by about 3% over the next 12 months. So true growth in the actual dividends you get in your hand, and a very attractive high dividend yield currently at about 5.3%. And why does that happen? Because we are investing in companies which are well priced and they're growing over time. And we believe that these are long-term investments. We're not investing just for tomorrow. We're not a trading portfolio. We're a long-term investment portfolio. So we have 2 dedicated managers who are looking after Asia Pacific real income as a portfolio. And they have 23 years and 18 years experience between them. And this is a team who really, based on the team they work with as well, so the total team is 17 people, but these 2 individuals go out, select securities, look at companies in the Asia Pacific region that meet that criteria of quality, valuation, direction, and sustainable dividends. And they build a nice concentrated portfolio of between 35 and 55 stocks. Again, we invest for the long term. We want to deliver healthy, attractive returns to our investors in the long term.